right here. Beautiful strong candle, closed above resistance. Textbook entry for most traders. Now watch what happens next. Everyone who bought that breakout, they're trapped, and their stops, right here, just became rocket fuel for the move down. I'm going to show you exactly how to spot these patterns before they happen, so you're not the one getting stopped out. You'll be the one profiting from it. Here's the concept that changed everything for me. Every single candle on your chart represents real people, real positions, real money at risk. And when those people are wrong, they have to exit. Their exit is your entry. Trapped traders aren't random. They cluster at predictable locations. They enter at predictable patterns. And when price goes against them, they panic at predictable moments. I want you to remember this. Your job isn't to predict where price will go. Your job is to see where traders are trapped and position yourself to profit when their stops get hit. I'm going to show you 6 specific patterns where traders get trapped the most. These aren't textbook patterns. These are trap patterns. And once you see them, you'll never unsee them. Let's start with the smallest time frame where traps happen, inside a single candle. Look at this candle. Long wick up, small body at the bottom. Classic rejection. Traders see this and think, sellers stepped in, time to short. But watch what I'm looking at instead. That long wick. Someone bought up there. Actually, a lot of people bought up there. During the formation of this candle, price was at the top. Traders saw breakout and they entered long. Then price reversed and closed at the bottom. Now those traders are holding losing positions. And here's the thing. Where are their stops? Just below this low. Here's how I profit. I don't short immediately on the pin bar. I wait. I want to see price reject away from that wick zone. The moment it does, those trapped longs are confirmed. The move down accelerates because their stops and new shorts are both pushing the same direction. Look at that. That's not just selling. That's trapped longs liquidating. That's fuel. Now here's one that destroys pattern traders. Bullish engulfing candle. Price was falling. Then this big green candle swallows the previous red one. Textbook reversal signal. Every trading course teaches this. So what do traders do? They buy. Watch the next candle. It doesn't just fail, it engulfs the engulfing. Now every single person who bought that pattern is underwater immediately. I took this exact trade backwards for months before I understood what was happening. The pattern wasn't wrong. The traders who entered on it became the liquidity for the real move. Here's the play. When an engulfing pattern fails within 1 or 2 candles, you trade the failure direction. Not because the pattern was wrong, but because everyone who traded it just became trapped. Their stops fuel your move. You now see something most traders never will. Those pretty candlestick patterns everyone memorizes. They're not signals. They're traps waiting to happen. And now you know which side of the trap to be on. This is where the most money gets taken from retail traders. The false breakout. Here's the thing about breakouts. Everyone sees them. Everyone trades them. And that's exactly why they fail so often. Here's a range. Clear resistance at the top. Price has touched it many times. This time, it breaks. Strong candle closes above resistance. Every breakout trader on the planet is buying this. Now look at what happens over the next 3 candles. Price doesn't accelerate. It stalls. Then it slips back below the resistance level. Now it's inside the range again. Here's the question. Where are all those breakout traders' stops? 2 places. First, just below the breakout candle, tight stops. Second, just below the range. When price re-enters the range, the tight stops get hit immediately. But the real move, that happens when price pushes toward the bottom of the range and triggers the wider stops. Watch this cascade. That's not selling, that's liquidation. Breakout traders funding the move against them. This is your trade. Wait for the false breakout to confirm. Price breaks out, fails, reverses back inside. Now you trade opposite the breakout. You're trading with the stop cascade, not against it. Those trapped breakout longs are your fuel. They become liquidity, your liquidity. That's breakouts. But there's another trap that's even more deceptive, and it catches experienced traders, not just beginners. I'll show you that next. Look at this uptrend. Clean trend line. Price has respected it 3 times. Then it breaks below. Traders see this and think reversal. The uptrend is over, time to short. But watch what happens. Price dips below, triggers all the short entries, then immediately recovers and continues the uptrend. Those short sellers trapped, and their stops are sitting right above where they entered. This happened to me so many times before I figured out the pattern. You see, trendline breaks without momentum usually fail. Here's what I look for now. When price breaks a trend line but doesn't accelerate, I don't short it. I wait for the recovery. The moment price gets back above the trend line, I go long, because I'm trading with the original trend, and I'm getting fueled by all the stops of traders who shorted the break. Look at that push. That's not just buying, that's short covering. That's trapped traders funding my trade. You're starting to see the market differently now. Every breakout, every trend line break. You're not asking, is this real anymore? You're asking, where are the stops? That's the shift. Now we get to the patterns that trap the most traders at once. Pattern traders are everywhere. They read the same books, they see the same setups, and they all get trapped together. Here's a double top, the most recognized reversal pattern in trading. Price makes a high, pulls back, makes roughly the same high again. Textbook short entry. Where do traders short this? Right at the second peak or on the break below the neckline. Now watch. Price doesn't reverse. It breaks above both peaks. Every single trader who shorted the double top is now trapped. And where are their stops? Directly above the double top highs. Every one of them. When price breaks above, those stops trigger. But here's the thing. Stop losses on shorts are buy orders. So the market doesn't just break above the double top, it accelerates through it. This is why failed double tops become the most powerful continuation patterns. The trapped shorts don't just exit, they fuel the move against them. My rule, when a double top gets broken to the upside, I'm not upset I missed the reversal. I'm looking for a pullback to get long. The move has fuel behind it. Next are triangles. Everyone watches them. Symmetrical, ascending, descending, doesn't matter. Traders sit on the edges, waiting for the breakout direction. But here's what makes triangles so dangerous. Both sides are loaded with pending orders. Breakout longs above, breakout shorts below. Watch what happens when price breaks one direction first. It goes up, longs enter. Then it immediately reverses, comes back into the triangle, and breaks the other way. 2 sets of traders are now trapped. The longs who bought the initial breakout, and the shorts who got stopped out on that fake move up. When a triangle fails like this, the move is usually explosive. You've got longs liquidating and new shorts entering at the same time. Maximum fuel. Here's my play. I don't trade triangle breakouts. I wait. If the first break fails and price reverses through the opposite side, that's my entry. By then, I know who's trapped and where their stops are. Okay, you've got the patterns now, but there's one more trap that has nothing to do with patterns. It happens at the same time almost every day, and it catches the most aggressive traders. That's coming up. This is the trap that catches momentum traders every single day. New session opens. London, New York, doesn't matter. The first 15 to 30 minutes show a strong move in one direction. Traders see momentum and they enter. The direction is set for the day, they say. But watch what happens over the next hour. Price doesn't continue. It reverses. And it doesn't just reverse. It trends the opposite direction for the rest of the session. Every trader who followed the opening move is now on the wrong side. Here's what I do now. I don't trade the first 15 to 30 minutes. I let the opening range establish. I mark the high and low of that range. Then I watch. If price breaks one side of the range and fails, I look for the opposite direction. Opening range failures trap the most aggressive traders. Their stops become fuel for the real move of the session. You're not watching the market the same way anymore. You're seeing the trap before it closes. That's not a small thing. Here's what you now have. This is the complete trap trader framework. First, candlestick traps. Pin bars show you who's trapped in the wick. Engulfing failures show you who's trapped in the pattern. Second, breakout traps. Fakeouts and trendline breaks show you who entered too early. Third, pattern traps. Double tops and triangles that fail show you where maximum stops are sitting. And fourth, session traps. Opening range failures show you where aggressive traders got caught. Every trap has the same structure. Traders enter, price reverses, stops cluster, price hunts those stops. Your job is to spot the trap before the hunt. Enter with the hunters, not the hunted. Every single trade setup you take from now on, ask this question: who's trapped and where are their stops? If you can answer that, you're not guessing anymore. But there's one more layer that ties it all together. It's waiting for you in the next video. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for.